Hello everyone and welcome to This Week in the Markets. In today's update, we'll go through the important events last week, namely the results of the European Summit and the court ruling on US healthcare reform. Then we'll discuss the effect of global central bank easing policies and what it could imply for commodities and precious metals. But before we continue, I'm obliged to show you our disclaimer. So information contained in this video is intended to be general advice only and should not be relied upon as financial product advice. Furthermore, the advice has been prepared without taking into account your objectives, financial situation, or particular needs. So you should, before acting on the advice, if you choose to act, consider the appropriateness of the advice, having regards to your objectives, financial situation, and needs. So the European Leaders Summit was the biggest news last week, and the summit was rather successful with a few unexpected compromises made by German Chancellor Angela Merkel. In particular, the Euro leaders agreed to drop the requirements that governments get a preferred creditor status on crisis loans, and also allowed the ESM to directly bail out insolvent banks and to purchase sovereign bonds of troubled nations. These measures are means to reduce the cost of borrowings for countries such as Italy and Spain. So this is obviously positive for market sentiments, but it is by no means an end to conflict in Europe. There's a few reasons. Firstly, the ESM involvement is conditioned on the formation of a centralized banking supervisory. This means that countries within the Eurozone will have to give up much of its power to regulate banks. Secondly, under the agreement, all ESM disbursement will need to be approved by at least 85% of ESM capital shares. This is already creating a problem on Monday because both Finland and Netherlands voiced their opposition to using the ESM funds to lower the borrowing costs for countries such as Italy and Spain. The two countries are relatively small contributors and account for only 7.5% of ESM capital shares, but Germany, having over 27% capital shares alone, means that any and every disbursement would need to be approved by Germany before it gets passed. Thirdly, it is still unclear whether or not the projected 500 billion ESM fund could be raised, and even if it is raised, whether it is sufficient to bring the sovereign debt crisis under control. So as we said in last week's video, this summit will not be the last one, and much more coordinated effort will be required to bring the debt crisis under control. Nonetheless, this is a key milestone to achieve, and the market reacted positively to this news. Last Thursday, the Supreme Court in US unexpectedly upheld a ruling that the Affordable Care Act of 2010, or also known as Obamacare, is constitutional. This law requires that by the beginning of 2014, all Americans are to have adequate health insurance, and employers with over 50 staff must also provide health insurance or otherwise pay a penalty. So effectively, this is like an additional tax on the economy and could potentially weaken the fragile jobs market. To the healthcare industry, the effect of this policy is mixed. The ACA is perhaps the most beneficial to hospitals and generic brands pharmaceuticals because there will be more patients under cover, which means that they are more willing to use the products and services provided by these companies. For insurance companies, however, although they are able to acquire a larger number of policy takers, they are prohibited from denying insurance even to those with pre-existing health conditions. This means that the number of risky policies that they take on also increases, and this might actually impact the bottom line numbers. On the positive side, the uncertainties with the healthcare reform has been ongoing since 2010. So the fact that the court has made a decision now might actually be positive for businesses because they can now factor in the costs and budget accordingly. But we'll have to wait to see how this actually impacts the jobs numbers in the next few months. There's a growing trend for central banks around the world to engage in more easing monetary policies. For example, a Chinese state-owned newspaper on Tuesday suggested that the time is ripe for another reserve cut from the Bank of China, which will be the fourth one in the last 12 months. This is to help to boost the economy lendings and also to try to stimulate the economy. The last time this newspaper published a commentary that urged the central bank to cut rates, well, it did so the next day. The European Central Bank and the Bank of England are also scheduled to meet today, and it is widely expected that the ECB will announce a rate cut of at least 25 basis points, and perhaps to even hint at some stimulus program. The Bank of England is also expected to expand its quantitative easing program. In Japan, the central bank announced a target inflation rate of 1% in February, but that has not yet been achieved because the latest CPI data shows that inflation was only at around 0.4% in April. So the Bank of Japan has also more room to expand its stimulus program. The Federal Reserve in US is also expected to take on more aggressive actions, especially after the non-farm payroll report this Friday. Currently, the expectations are that jobs will remain below the 100,000 level for a third consecutive month. So the Fed is expected to take some actions to boost growth. At the moment, the market is not too worried about inflation because the talk of the street is the slowdown in China, the crisis in Europe, and the lack of jobs in US. However, if global central banks does engage in more aggressive expansionary monetary policies, it could again raise inflation fears, as fiat currency, or another word, paper currencies, are diluted. This could create a situation like 2009 and 2010, where investors rush into commodities. As we can see in the chart, the gold and silver, especially for precious metals, they went in there aggressively in 2009 and 2010 for inflation hedges. Also, currencies with a close correlation to commodities such as Australian dollar, New Zealand dollar, and Canadian dollar are also expected to do well in a high inflation environment. So that is all from us this week. Remember to keep an eye out on the results of the Bank of England and the ECB rates decision meeting on later today, and also the US non-farm payroll tomorrow, as they are expected to move the market quite significantly. We will review the results of these meetings next week video. Until then, on behalf of the Trading Pursuits team, we wish you a profitable trading.